Hello, I'm RJ Kelly. I'm founder and chief visionary officer of Wealth Legacy Group in San Diego, California. We've got clients in 21 states. And in the course of that, we find ideas that we can apply to those clients in various states. Some states have more in the way of income tax, like California, New York, New Jersey, Illinois, and some of those nasty ones. But there are still even good old states like North Carolina and other states that have lower taxes. We're going to share an idea that will make sense to you no matter where you are. So I have the privilege of being in a producer group called the Elite Producer Group. Most of our revenue is generated from our assets under management as well as our tax mitigation planning work. But we also have a robust life and disability insurance practice. And in the course of that is how I ended up joining Elite. And in the course of that, I also had Tom Toos, who was the executive director, say, you need to meet immediately Bryan Setzler in North Carolina, who is in any room is going to be one of the brightest minds there. And I've found that not only be absolutely true, Bryan is doing some things that I've not heard from anybody else. But in addition, he's just a super nice guy. So we were chatting, having some fun a couple of weeks ago on a couple other things that we're working on. And I just said, Bryan, could we do some recording together? Could we bring you in and let you share some ideas with us? And he's gracious man that he is. He said, you bet. So, Bryan, thanks so much for being with us this morning and or this afternoon, depending where you are right now, and for where their folks are listening. We do have another webinar that we did on IRA maximization. Right now, we're going to talk, though, about, we were chatting on break about a new car that's coming out in I think it was Germany, that is actually a flying car. It's a three-legged flying car, which sounds really cool. Reminded me of the movie Back to the Future. So we're going to talk in this segment about going back to the future. How can we start planning today to have even more spendable income that is tax advantaged? And it means that we have to do some things today, not much, but we have to do some things today. And so you're going to walk us through how most of us can increase by thinking ahead. We can increase our net spendable income once we're in retirement. So again, Bryan Setzler, great to have you with us. Take it away.
Well, thank you, RJ. So great to be here. On the last segment, we talked about this idea of recapitalizing the IRA for those individuals that were older than the age of 59 and a half. They would see the wisdom of trying to get the maximum efficiency and maximum performance out of their qualified plan balances. It occurred to me, RJ, that there's even more people within employer-sponsored retirement plans, 401k plans, and profit-sharing plans that are much younger than the age of 59 and a half. And those individuals invariably will ask our firm questions like, well, what can I do? What should I be doing to better prepare for my future retirement? And prior to the strategy, the best answer that we would be able to give a family like that would be, well, you just need to participate in your employer-sponsored plan, at least up to the matching contribution. Take a look at the asset allocation made available to you by your employer and do your best to spread your eggs in the basket and diversify and prepare over time. But that's a very general sort of a recommendation, not very specific. Once we started actually forecasting the income tax burden associated with those future distributions that these participants are likely to take out, what we were able to put together with this presentation is we're pointing out to these participants that, number one, all income in retirement will be taxable, which is not a surprise. So if you think about it, if you're working now, everybody knows the difference between their gross pay and their net pay. And the difference, of course, is taxes and withholdings. So most participants in 401k plans, there's a line item for federal tax, state tax, FICA, which is Social Security, as you know, any contributions to their 401k profit sharing plan, medical plan, and then, of course, that would be what's left is the net pay. So what we want to do is remind them that's also going to be true during retirement, that any income source, with very few exceptions, are also going to be subject to income taxes during retirement. Things like 401k or IRA distributions, Social Security income, up to 85% of that could easily be taxable. Dividends, interest, Muni bond interest is not, but that's basically one of the few things that are non-taxable. The thing that kept jumping up to people when we were talking to them, everyone raised their hand, RJ, and said, I was not aware that they are going to tax my Social Security also. Has that been your experience, that people are surprised by that? They're younger than retirement age?
Well, it sure is. And they don't even think about it. In fact, for most of us, we're not even ever been thinking that we would ever qualify for Social Security. And now there's a few of us that have silver hair like I do. They're going, you know what? That's going to happen pretty soon. So not only that, but some states don't tax it. Some states do. And so it is a big adjustment depending on which state you are as to whether your Social Security benefits are going to be taxed twice, one federally and then also at the state level, or maybe just at the federal level.
And so when we got into that, it's very complicated. There's this thing in the tax code called provisional income, which has to do with the total taxable income. There's a certain percentage of Social Security gets added to all their other taxable sources of income. So what we wanted to do here is show an example of a 49-year-old business executive who currently has amassed a $500,000 balance in their qualified retirement plan. Between this individual and his employer match, he's contributing $27,000 a year in an effort to try to do a good job in preparing himself for retirement. If he continues to do that, his $500,000, along with the contributions of $27,000, are projected to grow in value to be almost over $2 million as he approaches his retirement age. So if this individual were to then retire at 68, take 6% distribution from that $2 million nest egg, that means he would be taking out $120,000. He would also be a participant in the Social Security system. Could easily have $60,000 between he and his wife coming from Social Security. We made a plug for $30,000 of other taxable income. And the reason we did that for this example is the standard deduction right now for married couples is $29,200. Well, instead of calling it the standard deduction, we could just call it the zero tax bracket, So if we think of whatever the standard deduction is, a zero tax bracket, and just say the first $30,000 in the future is a gimme from a tax standpoint, meaning every dollar added to $30,000 will be subject to income tax. In this case, we calculated it, and the federal tax burden for this individual is coming in at $31,000. State of North Carolina is $8,800, leaving him a projected get to spend lifestyle 18 years from now. So it's not inflation adjusted, but we're coming in at $14,000 a month. So the question is, what can we do to make a meaningful improvement on an individual who's projected to benefit by $14,000 a month to spend during their retirement? And the answer is, what we should be able to do is, what if we can transform the tax status or the taxability of those distributions coming from that retirement plan? And if we're able to do that, we can make a dramatic improvement, not only on the total income, if we do it correctly, but we can also make a dramatic impact on the net after tax get to spend amount. That's the objective here. So door number 2 is, instead of 120 taxable, how about 135 tax-free, coming from a specially designed tax-free life insurance arrangement, bringing his total income to $225. What's interesting is, because that $135 is non-taxable, his federal tax bill went down from $31,000 down to less than $2,000 a year. That one change transformed this person's projected retirement from $14,000 a month to $18,000 a month. So we're talking about a 33% improvement in spendable income on day one of retirement, just by doing a better job and being prepared. Isn't that amazing? And
Bryan, I find one of the other things that I find all the time is that most people aren't aware that they can take money out of their life insurance as long as it's properly designed, and that will be non-taxable. Now, I get it that you put your money in, you take your money out. Of course, that portion would be non-taxable. But it's also on the growth. And so again, we won't take the time in this podcast right now, but just understand that that's something else that, as Bryan's talking about, that life insurance can be a very valuable tool for providing tax-free income in those later years.
No, it's very exciting. And I just didn't ever actually calculate the dramatic impact to the tax on the Social Security as part of that. Once we add the two things together, then this idea becomes more than I've got a product better than your product. This discussion becomes, if we were willing to consider swapping products with me, not only do you get a better product, meaning you pay less tax, it also saves taxes on your Social Security. In this case, this gentleman's projected to benefit by $3.5 million through his age 100 just by creating an account pre-retirement that he can use later for the purpose of recapitalizing that qualified plan balance. So just tremendous. So RJ, based on this slide, we're talking about $3.5 million of an improvement over this gentleman's lifetime just by organizing his affairs. Takes probably 30 minutes of his time before retirement to establish an account early that he can use to accomplish multiple objectives, culminating in over $3.5 million of a lifetime income advantage. Isn't that exciting?
That's amazing. That's absolutely amazing.
So then the question becomes, well, what are you going to ask me to do? I'm all ears. What can I do to have $3.5 million more money? What is the catch? What do I have to do? What we're asking them to do is consider establishing a properly designed life insurance policy today while they're working. The benefits of that would be multifaceted. Number one, if someone were to die before retirement, of course, the tax-free death benefit would help replace their earning power to their family. So it's not a cost in absence of value. We're asking them to write a check to acquire life insurance that provides a meaningful benefit should someone die too soon. On the other hand, if you're perfectly healthy at age 60, based on the new government rules associated with the amount of money that you're allowed to deposit into these life insurance policies, turns out in many cases, the client is able to put either all or almost all of their 401k balance directly into the policy over a 5 or 6 year period of time once they're older than the age of 60. Now, why would they do that? If they do that, the idea is that they're paying income taxes while they're finishing their working career. So in anticipation of retirement, their first day of retirement, all of that stream that we talked about, or very high percentage of it, could easily be income tax free, setting them up for a virtually completely income tax free retirement. And that's what I think the power of this particular strategy is.
Many people, and myself included, were not aware that once you go onto Medicare, there's something called the IRMA, which is if you make too much money, if you've got too much taxable income, you've got to pay a higher cost for part of your Medicare. Well, that can amount to literally hundreds and hundreds of extra dollars every month. So if we can keep that income stream lower and not taxable, well, guess what? The income coming out of these specially designed, these hybrid type of life insurance contracts are not subject to that potential IRMA tax. So it's savings not only from an income tax, but it also could be hundreds of dollars a month savings in not having to pay the penalty on your Medicare.
Yeah, it's pretty tremendous, really. It's three aspects of this. Number one, they get a bigger income stream coming from the source. Number two, they avoid income taxes on their Social Security. And you're saying, number three, they pay a lesser price or cost associated with their Medicare.
Those of you who are 40 or so, maybe younger out there watching this, are going to say, what? What's Medicare? Even in your 50s? But trust me, it comes fast, and it is an important element in all of us here as Americans. It will be here for you too.
Yeah, so in this particular case study we did, it's $3,000 a month for the first year, lowering to around $1,300 or $1,400 a month to establish a $1.2 million permanent policy. Most of the funding is available in cash value growth. And so once this gentleman, who's now 49, 11 years from now, go by in a blink, he'll be 60 and then eligible to use this policy for the purpose of tax cleansing his entire 401k profit sharing balance. So at that point, we're allowed to gradually take the money from the qualified plan, in this case over a 5-year period of time, $300,000 a year, we're able to stuff into this instrument, which supercharges it. We can use policy loans to offset his income tax burden associated with the distribution of his qualified plan balance, and it sets him up for a very rosy post-retirement cash flow. He has $60,000 a year coming from Social Security, $135,000 a year coming from this particular product, assuming a 6% growth rate, plus any other income that he has. So this gentleman will have a really nice retirement, and the magnitude of it is pretty remarkable. You're talking about a 33 to 40% increase in his spendable retirement income, lesser Medicare costs, like you pointed out, permanent life insurance that's available whenever he dies, to include chronic care coverage if he gets sick and needs additional income for the purposes of chronic care coverage. So all the way around, I think we've done a really good job using straightforward planning. And the grand total of what we're talking about, we're only asking him to put about $200,000 over 11 years into a new account. And just by doing so, he benefits by $3.5 million over his lifetime, which is tremendous. There is no other investment he could do that.
Some out there will be saying, oh my gosh, $200,000, that's not really expensive. Well, again, thinking about this is a special hybrid type of insurance product. So that is not a cost. If I take $100 out of my left pocket and put it in my right-hand pocket, what did it cost me? Well, it's just the time value of the money, if you will, from moving from pocket one to pocket two. So if you did need money for an emergency or opportunity prior to age 61, 62, 65, 70, you have access to that money. And it's available with, again, it's properly designed. There are people out there that don't know how to do that, but we do. So as long as it's properly designed, you can access that money and not pay tax, even though the growth may exceed the value of the dollars that you contributed. I had a situation a number of years ago where I had, between my life insurance contract and savings, which is also good to have, we had an opportunity that came up for a property here in San Diego. There's a little community called Coronado, just a lovely little community on the other side of a 2.1 mile bridge. And I happened to go through a property, and because my wife loves to go through properties, and just to look, poke around. And this one immediately showed me that the value was far greater than what they were asking for. And so I did some sleuthing, found out that the reason that it was being sold was to pay for some taxes. So we put in an offer because we were able to get money out of our life insurance contract and out of our savings very quickly. And we're able to come in and make an offer before anyone else could, and walked away with a property literally at 29 cents on the dollar, as it turned out. So this is not something necessarily that money has to be kept all the way until their retirement. But again, this is money. Think of it as a savings, that you're putting money away in an alternative type of vault where it's protected in most cases against creditors. Many states provide protection for values that are cash values in insurance contracts. And then that money can be used, again, as Bryan's pointing out, ideally for the future. But if you have just a killer opportunity like we did, it's also available in the meantime. So, Bryan, back to you.
No, that's an excellent point. What if this client finds a retirement home that they can't wait for a bank to give them a financing approval? They could just immediately lock it up under contract, take the money out of the life insurance policy, buy it, and then when their other home sells, repay the distribution back into the policy. So it offers tremendous flexibility. Since there's no tax to worry about, you can sweep money in and out of the policy without any trouble.
Great point.
But anyway, I thought this was beneficial to talk about, because usually when we're talking about any IRA or qualified retirement plan concepts, we're talking about people that are older than the age of 60. This is good in a way because it affords people much younger to use tools to augment their qualified plan in a particular way, so that you end up in a net plus as they get closer to their retirement.
So there you have it. Back to the future. So we're going to have flying cars, and you're going to have a much better retirement if we can just plan a couple of decades ahead and set money aside into some things that you'll be so glad for. It's like the story, I'll close with this. there was some Arabian horsemen were at night going across the desert, and they heard a voice call out to them from the darkness and said, dismount from your horses and camels, go to the riverbed and take the stones and rocks that are in the riverbed and put them in your saddlebags. And if you do, in the morning, you'll be both happy and sad. Well, the riders look at each other a bit puzzled, to say the least, but they did as the voice had commanded. They went down to that dry riverbed, gathered rocks and stones, and put in their saddlebags to wake up tomorrow to see what would happen. And in the morning, they were indeed both happy and sad, because overnight, those rocks and stones had turned into precious, beautiful emeralds and diamonds and rubies and jewelry that was just unimaginable. So they were very happy that they had done what the voice had told them to do at the night, but they were sad because they hadn't taken more. So there you have it. No matter what, let's plan ahead. Let's have, in addition to those flying cars, let's make sure that you're financially well prepared. I'm RJ Kelly, Wealth Legacy Group. Thanks so much for being with us. We've got another video that we've got with Bryan that'll be coming up. This will be one for business owners. What can you do to dramatically reduce the cost of when you sell your business? Well, how can you plan ahead so you'll have dramatically less expenses to pay when you do sell that business? So again, RJ Kelly, thanks so much for being with us. Can't wait to see you on the next video.